Hello everybody, welcome back to Trade with Ricky. Today we're gonna talk about interest rates. And as you guys probably know, today was an important day in the US because the Federal Reserve increased the interest rates by a quarter percentage. So now the range is between 1.75 and 2%. The reason for the increase in the interest rates was that because according to the data, our labor productivity is really strong, our economic numbers are really strong, and our economy in general is really strong, and is outgrowing our long run target. So we need to tighten up our economy. So we need to increase the interest rates. Policymakers projected 2 additional hikes by the end of the year, and before the previous estimation was 1. So this was probably the biggest news of today, because everybody knew that the Fed was going to increase interest rates, but they didn't expect them to announce an extra hike increase by the end of the year. So today I'm gonna compare interest rates with many other important indicators in our economy, and how important are those indicators for you, your portfolio, and for your investment decisions. Every single chart are gonna be provided by Trinity Economics, which is a really useful site because you can go there and you can look up at the most important economic indicators of any country in the world. So if you want to check what is the unemployment rate in Argentina, just go there and then look for that. So on the left I have the US Fed fund rate, and on the right I have the inflation rate. As you guys can see from the chart, interest rates and inflation rate, they kind of go along with each other, because in order to lower down inflation rate, the Federal Reserve wants to increase the interest rate. As you can see, 1980 was a big year. Inflation was at 20%, and interest rates were at the highest point. For the past 10 years after the Great Recession, our interest rates have been so low, at the lowest ever, for 10 years straight. Now they're about 1.75-2%. So right now we're experiencing a new type of economics because the interest rates were never this low before. So we're gonna see many people, like, they just look at the numbers. They're like, labor productivity is good, economy is good, there is no way there's going to be a crash or recession. Well, unfortunately, history repeats itself. That's why charts like this and other important economic indicators are really useful in order to forecast the potential future outlook of the economy. It's really hard to forecast a recession because there have to be many different facts that come along that create a recession. So but those charts, those economic indicators are really important in order to understand where are we going, what's our direction, where is the economy going. So interest rates have been so low in order to keep inflation at 2%. As you can see, after the 1980, inflation has been pretty much close to 2% throughout most of the years. Of course, every time there is a recession or correction right before that time, inflation goes up and interest rates are up. One thing to notice is that in 1980, interest rates went up steadily every single quarter until it met the goal. In 2007, or right before 2007, as you can see from the chart of the interest rates the line right before 2007 is really steep. It's not flat, meaning that after a couple of years of really low interest rates, no, people didn't expect interest rates to jump this much. No, in 1980, because of the oil crisis and all of that, and the price of oil was skyrocketing, inflation was going up. So everybody knew that the price of transportation and other many goods, because of the oil, were going up. So interest rates were increasing, and everybody was expecting that. But in 2007, no. In 2007, inflation rates were really low, and then you see a major increase in interest rates right before 2007, which really was an important indicator of the recession. Because if you have a credit card, and if you have money to a bank, if you have a loan, no, and you have interest rates at 1.5%, for example, and you see that there is no increase in interest rates, so you're confident. And then after 6 months or 6 months or 1 year, it goes up to 7%, 8%. You're not prepared for that. So that was a big factor also for the recession. Because as you can see from an increase in interest rates that steep, I really didn't see. You cannot see in the chart. No. So it's important to see what is going to happen now after 10 years of low interest rates, because for 10 years the market is being going up. Our economy is being going up. And many things in the market are overvalued. So now that they're trying to tighten the economy, and the fact the market is overvalued, unfortunately, there is a risk that in the upcoming years, probably in 2019, 20 or 21, so in a 3 years range, we can see a drop in the market, in the stock market, and in general, just because we need to tie up the economy. So that's the relationship between inflation rate and interest rates. It's a direct relationship. Increase interest rates in order to fight high inflation rate. Mortgage rates. Mortgage rate. This chart goes from 1990s to today. Even though you cannot see much left at the end of the graph, but you're not missing much. Those are just the years. So it's even interest rates, they command mortgage rates. So it's very common to understand that interest rates and mortgage rates are pretty much correlated. Are pretty much, as you guys can see, at the end of the mortgage of the 30-year mortgage rate, now it's going up 4%. The interest rates at the end of the graph, they should be going up, but I don't know why it didn't pass to this PowerPoint presentation. But actually, if you go on tradingeconomics.com and you see the Fed fund rate chart, just like this one, you can see that there is a big bump going up. So there is a direct precise relationship between interest rates and mortgage rate. Not much to explain here. So the credit lenders, they use the interest rates in order to make their own mortgage rate to give it to the borrowers. So as you can see, like when there is a recession, right before there is a recession, mortgage rate are really high compared to the years before. So it's something to see. Like in 2007, I think they were about 7%, more than 6%. So let's move on. It's pretty much easy to understand that there is a direct relationship between the two. Okay, this is really useful bonds, because you will see at the end I will talk about yield curve, which is a really important indicator. So bonds, this is the chart for the 10-year bond compared to the federal fund rate. Next time I'm gonna put the chart a little bit up, because my screen is coming up the chart. I'm sorry about that. So bonds market, when of course over here, what is bond? What is bond? Basically this is a 10-year bond. This is the yield on the bond. So basically, when interest rates are high, the bond yield are high. So even here, there's a direct relationship. 1980, higher bond, higher interest rates. 2000s, low interest rates, close to zero. 2007, interest rates same. So as you can see, direct relationship, because when you buy the bond, when you buy a 10-year bond, basically, so when you buy a 10-year bond, it means that the expiration for that bond, the maturity of that bond is 10 years. And it's 10 years. Actually, today, it might be a good time to buy bond, because since our economy has been so strong for 10 years after the recession, and since interest rates have been so low, and now that the Federal Reserve has started to increase the interest rates, and they announced 2 more interest rates, and the fact that they're trying to slow down the economy, because the economy is going too is growing too strong. Now it's a good time to buy again bond, even though you will say that historically bond have not provided a great investment. But we'll see. But if you look at the chart, you can assume that with the fact that interest rates are about to increase even more than 2% and probably reach 2.8, 2.9, now you can still buy a bond and make a good return on your investment in the upcoming years, since the bond have been so low for many years after 1980s. Gold and interest rates. So gold is the safe investment when something bad happens to the economy. When there's a recession, when the economy goes down, investors want to buy gold as a safe escape plan. So as you can see, even gold for the past, I would say since 2000 until now, so 18 years, gold has been going up pretty much all the way straight up. This reminds me of the Bitcoin chart. Yeah, if you look at the Bitcoin chart, it's just like that. So as you can see, high interest rates, 1980, this means that inflation was high. This means that we were trying to tighten the economy, so there was a correction, a recession, a crisis. There was a spike in gold. Easy to understand. Look at that. Look at 1980. Look at 1980. Higher interest rates, higher gold price. Then from 1980 to 2000, interest rates steadily decreased. Gold didn't move much. After 2000, so with the technology boom, war in Iraq, all the fear of terrorism, all the market what was happening in the market back then, all the way to 2010, when interest rates were still 2010. No, actually, I would say 2007. Because after 2007, the Federal Reserve, they lowered down the interest rates pretty much to zero, because in December 2008, interest rates were 0.25. So pretty much until 2010, the chart, gold went up gold went up all the way to almost $2,000 per ounce. Now, so as you can see, when interest rates are high, there is a fear of a crash. We want to tighten the economy. Investors buy gold. When the economy is strong, when interest rates are low, like they've been for the past 10 years, as you can see, there was a big major drop in gold price, until today. That's because interest rates have been so low lately that there's so much confidence in our economy. So investors really don't invest in gold. But when there is a fear of recession, interest rates are high, gold is a safe investment. I'm using the Nasdaq just because I didn't find a really good chart of the SP 500 to compare with the federal funds rate. But today, SP 500 is the benchmark of our economy. So you see in the Nasdaq chart, in the Nasdaq graph, you see some gray bars. Those represent a recession and correction in our economy. So from 1975 all the way to today. So today we are at all-time high. So let's analyze some key points so you guys can understand what's going on. 1980. Pretty much 1980, late 70, 1980, interest rates are high. There's a drop in the Nasdaq. Actually, the drop in the Nasdaq that year wasn't that really that much. Then after 1980, interest rates they start to decline, as you can see. And they've been declining all the way until 2007, pretty much, as you can see from the federal fund graph, which means that the Nasdaq has been going up, straight up, all the way to 2000. Then the tech bubble popped, so the Nasdaq went down, and interest rates went up. And then interest rates were low again, Nasdaq went up. Then 2007 came around, there was a recession, interest rates went up immediately, Nasdaq dropped 50% in that year. Then after 2007, interest rates set at lower level ever, 0.25 in 2008. Pretty much 0.25, 0.5 for the past 8 years, and then in the past 2 years they've increased a little bit. Now it's 1.75, 2%. Nasdaq has been going up. So as you can see, when interest rates are low, that means that people can borrow money at a lower interest rate. So there is more people buying stuff, buying property, making more investments, and of course we are in a booming economy. When interest rates are high, meaning that borrowing is becoming harder for the investor, people are more reluctant to invest, the Nasdaq and the stocks go down. Pretty much easy to understand. Unemployment and interest rates. I should have used the Phillips curve to explain this concept. I might use the Phillips curve in a different video, but I'm just gonna look at the two charts separately. So unemployment on the left and federal funds rate on the right. As you can see, high interest rates, unemployment rates are high. I'm using always the 1980 as the major example, just because that was the highest point for in our interest rates. As you can see, 1980 corresponded to the biggest level of unemployment in our recent post-war US economy history, as you can see. And then in 2007 it reached 10%, no? And you saw interest rates right before 2007 were high, and then for the past years unemployment went down because interest rates were kept so low, all the way to zero, in order to stimulate the economy. So people were able to find a job quite easily, and now unemployment is 3.8. So as you can see, easy relationship to analyze. When interest rates are high, it's hard. When interest rates are high, it's hard to borrow, no? So people want to save more than consume. So there is people buy less. People buy less, meaning that this not only affect their own personal economy, but even the major economy, because it affects unemployment rate. Because when people invest less, no, business and major companies and small firms, no, they see the profit going down, and when the profit go down, and when the profit goes down, many company either they close down or they cut the cost. And most of the time when they cut the cost, it means that they're gonna cut on the labor cost and they're gonna lay off many people. So it's pretty much easy to understand this relationship. Final point, yield curve, which is really important in order to kind of predict what is going to happen in the near future and when you want to invest. So yield curve, the major point of yield curve is to figure out when there is an inverted yield curve. Inverted yield curve is a sign of a change in the trend that usually leads to a correction or even a recession, such as the 2007 Great Recession. It plots the interest rates of bonds at different maturities. An inverted yield curve is one that has a higher yield for a short-term bond compared to a long-term bond. So now there's gonna be a graph of the current all the way to June 13th, which means today, after the Fed decision. I'm gonna show you what it means to have an inverted yield curve and what's the effect on our economy and on your investments and the stock market and economy in general. So this is the current yield curve. This is the yield curve as of today. So the yellow one at the bottom, this was last year today, 13 June 2007. As you can see, the one from last year was pretty much sloped up, meaning that the long-term bonds, the yield on those bonds were higher than today, no, than the short-term bonds, so 1 month, 3 months, and so on. Then you can see the green one, the blue one, and the pink one. Oh, actually it's purple. So, and the green one is from last month, the blue is from last week, and the purple one is from today. So I'm gonna pause and ask you a question so you see if you can get my point. If you analyze last year yield curve and if you analyze today's yield curve, no, what's the biggest difference? Okay, so as you can see, the yield curve from last year was sloping up, no? The yield curve from today is more flat. When there is a flat yield curve, and even worse, when there is an inverted yield curve, this always anticipates a recession. inverted yield curve is seen right before the 2007 Great Recession. Every time there is a major correction in the economy, every time there is a major correction, a major recession, there is an inverted yield curve, meaning that the yield, the interest rates on the bond for the short term is higher than the long term bond, because short-term bond, it becomes more expensive, and if you hold a long-term bond, you're gonna lose money. So pretty much I'm doing a recap of everything I explained in this video before I finish. So basically, my interest rates are really important when you make your investment decision. Either if you want to buy a house, if you want to buy a car, or if you want to invest in the stock market, if you want to invest in bonds and so on. Interest rates are set in order to fight inflation. We want to keep inflation low. Now, the target has been 2% for the past 10 years after the Great Recession. In fact, after 2007, interest rates have been at the lowest level ever. Unemployment goes up when interest rates are up, because borrowing it becomes more expensive. People save more than invest. They spend less money. So small companies in general, they see their profits go down, so they lay off people and unemployment goes up. And then we looked at Nasdaq and the stock markets in general. Low interest rates, there's a belief that the economy is strong. People invest more money, the stock market goes up. When there are high interest rates, the stock market tends to decline and to go down. That's because, as I said before, unemployment goes up, people invest less, and so on. So it's pretty much easy to understand. And then we look at bonds. Bonds is a perfect direct relationship with interest rates. And then finally, yield curve. We want to see if the yield curve is sloping up, it's flat, or if it's inverted. If it's inverted, this is a sign of a recession, because short-term bonds, they have higher yield than a long-term bond, and this always anticipates a recession. So hopefully you guys found this video pretty interesting. Interest rates are really an important topic to understand before you make your investment decision. Currently our economy is pretty strong, our labor productivity is pretty strong, but in the upcoming months, the Fed is gonna increase the interest rates even more. And so there is a chance that in 2019, 20 or 21, we're gonna see a decline in the stock market eventually, because our economy is being going up. The stock market has been going up for too long now compared to our historical level. And right now we are in a phase that the market is overvalued, and sometimes recession, as I said in my first video, they present an opportunity for the investor to invest at a lower price and make more money. So we'll see what is going to happen. Thank you again to be here and to watch this video, and for watching this video. Please subscribe, leave a comment, and the next video probably is gonna be more about economics, probably about trades and tariffs, since have been a major topic in the last months, and how tariffs affect unemployment rate and so on. Thank you again, guys. Subscribe, leave a comment, and let's make money together.